right, Charles is in. All right, so we'll get started right now. All right, so part one was about understanding products and the risks. So first thing first, we learned a little about equities. And equities pretty much consists of like stocks. And the first thing that we learned was about common stock, right? Common stock was pretty much a form of equity which gives you like ownership rights of a company, right? And then you receive dividends outside of that. And then some cons of common stock is that in the event of a bankruptcy, then you can actually lose that money you actually invested. If that makes sense. Those are the main parts for common stock. Any questions regarding this so far? No? All right, moving on. Obviously, there's some pros here, some cons, and I'm going to share you guys this Word document, which is what I created when I was doing my study guide for the SIE. And just know that there's a bankruptcy, which is a federal court procedure that allows both individuals and businesses to get relief from their debt. And there's just two different types of bankruptcies. Make sure you guys know what this is. Okay. And then preferred stock, it's very, very similar to common stock. The only thing that has a little bit different is that it's tied to a debt security. So what this means here is that anytime when the interest rates go up, that affects the preferred stock, which has an inverse relationship. Did you guys remember reading about that in the book? How it's tied with debt securities a little bit? And then overall, like it does have a little bit more benefits compared to common stock, which should be here somewhere here. These are the main types. Straight's pretty straightforward. Is that they only pay you the upcoming dividends. They won't pay you anything that was missed. Cumulative was pretty much that anytime when they miss or reduce the dividends, they're gonna make up for it and pay you back that money later on. And anytime when a future benefits the issuer, like when it says callable, usually it's going to work on the behalf of that issuer. So that means that that person actually bought this preferred stock in some way. He's going to have a higher dividend rate on that stock that he bought because that benefits the issuer. I don't know if that makes sense a little bit, or I'm gonna expand a little bit. And then we have convertible preferred. This allows you to convert your preferred stock to common stock. That's all it does. And adjustable rate preferred. The way you want to think about this one right here, it's kind of like it kind of protects you against inflation because it keeps up with the rates of returns and interest rates. And then this right here, it's regarding controlled securities and restricted securities, which you guys are seeing in the book in regards to Rule 144, right? And later on in the book for the SIE, it's going to go a little bit more in depth regarding Rule 144. But for right now, when you look at Rule 144, the main part of it is when you're dealing with securities that are private. When they're private, they're going to be considered restricted securities. And then when they're like private, majority of the time, those securities don't have to be registered. That's something you're going to learn in the SIE and the upcoming exams you got to take. Control security is pretty straightforward. It's for anyone that's a director, officer, or person who owns 10% or more of a company. Okay. And pretty much this right here, you're also going to have to know it, which is the 1% of the total outstanding shares of the same class at the time of sale. This word right here, you're gonna have to know it. And the 6-month period is very, very important. If you're affiliated, which pretty much means that you're a control person or you're like an officer or director, that holding period is going to hold for you for the 6 months, and you're going to have volume restrictions as long as you're affiliates, right? So those volume restrictions will be tied to this part right here pretty much. And anytime when you're not affiliated, that means that you don't have any restrictions that much compared to if you were affiliated. So anytime you see on the exam and it says affiliate, just make sure you think about there's gonna be more restrictions. Whether non-affiliate, it's gonna be less restrictions. Okay, and this does come up on the exam. Okay, what else? And when you're looking at this right here regarding like Rule 144, there's a little table right here. This little table right here, that's pretty much all you need to know. Just memorize this little table. It talks about Rule 144 and how it breaks down in 3 different branches. For restricted stock, unregistered, held by unaffiliated, has like a 6-month hold period, sell freely after those 6 months once they've been paid for in full. And restricted stocks, unregistered, held for an affiliate insider, 6-month hold, volume limits thereafter. And then 3 will be this one right here, the control stock. So just make sure that you guys memorize this little table. And on your exam, you're more than welcome to like write as much notes as you want on your little cheat sheet. Well, not cheat sheet, but on your scratch piece of paper. Does this stuff make sense so far? All right. And then we have about the American depository receipts. This is pretty straightforward. It pretty much makes it so you can invest in international companies easier. You pretty much deposit into a U.S. bank, and they give you a receipt, which pretty much shows that you invested in that company. That's pretty straightforward for the American depository receipts. This does come up in the exam. It's mostly like a definition. So just know what it is. Okay, a little bit about taxation here. And then penny stocks is pretty straightforward. With penny stocks, just keep in mind that it's anything listed that's unlisted that's unlisted for less than $5 per share. Anytime when you do have penny stocks, you do have to have statements given to your customers, and there's more disclosures involved as well. Okay, there's some rules for cold calling. If I'm not mistaken, this might come up on your exam, so just know the basics of the rules, and you'll be good. And it's pretty straightforward. You just gotta make sure you tell them the name of the penny stock, the number of shares to be purchased, a current quote, and the amount of commission that the firm and the rep received. And these provisions only apply if they're solicited. So solicited, all that means is that if I call you guys, it's considered solicited. But if they call me, it's considered unsolicited. So it's going to be less rules for when it's unsolicited. See, unsolicited transactions are exempt since not recommended by the broker dealer or registered rep. Okay. And then debt securities, whenever you look at the word bond, the way you want to think about it, it's like a loan. So when they issue out that loan, they're going to pay back the investor the principal plus the interest. Okay, so far? Okay, what else? All right, so there's different maturities. This will come up on the exam, this definition here with term, serial bond, and balloon. So make sure you know these definitions because they will come up on the exam. What else? Let me see. And then par value. Anytime when you see par value on the exam, you're gonna have to assume it's $1,000. $1,000. That's always gonna be the assumption. Okay, what else? And then right here, I'm gonna skip a little forward to right here. This little table right here, this fulcrum right here with the coupon, and it has these 3 lines here. This graph, it's very, very important that you know this too, because they're going to tell you what's going to happen if we sold a coupon at a discount. What's going to be, is the current yield going to be higher or is it going to be lower compared to the yield to maturity? So it's going to ask questions like that. So make sure you know this chart right here, okay? Does it make sense? Just make sure you know it. Okay. And there's different features for bonds. We have the call features, the put features. Anything that's a call, it's going to benefit the issuer. So it's going to be probably like a bond with the higher rate they're going to be paying out. Okay, what else? And then we have here treasury securities. Just know what it is, because T-bills, they're going to come up on the exam. You just got to know that T-bills is a short-term debt obligation, which is issued weekly with maturities of 4/13/26. But just keep in mind, it's going to be less than 1 year. That's going to be the most important thing here too. And it does not pay interest in the way other bonds do, sold at a discount below par value and redeemed at par. Because this will come up on the exam a little bit. There used to be like a little chart. There it is. There's that chart. So that chart right there, just make sure you know this. This is all you need to know for T-bills, T-notes, and T-bonds. Anybody have any questions so far in this? No? And on the exam, they do ask a few questions on like treasury receipts and treasury strips. Just make sure you know what it is, like the definition of it, which is this pretty much what it's meaning here. Broker dealers buy treasury securities, place them in a trust at a bank, and sell separate receipts against the principal and coupon payments. That's all that means. You're pretty much separating them. And anytime when they separate the coupon interest payments from the principal, it creates a new security and provides investors with several maturities to choose from. So that's why it's a little bit more attractive, because it has the several different maturities to choose from. Okay, what else is more regarding strips? And as far as the government agency issues, just make sure you know what this is, because it will come up on the exam. Does anybody have any questions so far? Any questions? No? Okay, what else? Then corporate bonds, it does come up on the exam. And corporate debt securities can be either secured or unsecured. So secured pretty much means that they're going to pay you back. Unsecured is that pretty much there's a risk that maybe they won't be able to pay you back. Unsecured, it's just backed only by the reputation, credit report, financial stability of the corporation. Secured debt securities are backed by various kinds of assets owned by the issuing corporation. Okay, what else? Equipment trust certificate. This one does come up on the exam. It's pretty much used as collateral. So corporations such as railroads and other transportation companies finance the acquisition of capital equipment used in the course of their business. And this kind of explains a little more. Railroads will issue equipment trust certificates to purchase the rolling stock in locomotives. So pretty much all it means here is that if they're not able to pay back, then they have the title of the new equipment and they can pretty much cash in that equipment to take back the money. That's all that means. Okay. And collateral trust, all it means here is that it allows a corporation to deposit instead securities as collateral for the lenders. That's all it means. Okay. Debentures, it's mostly they're going to ask you, debentures are going to show you a little more of the definition. So just make sure you know this definition right here. Okay, and then guaranteed bonds. Where are we at? And municipal securities, they will ask on this exam right here. And then most of the time when you do buy municipal securities, they're like tax free. It doesn't have to always be registered. Okay, what else? And make sure you know this part here too. The municipal securities settle trade date plus 2 days. That's very, very important. This part right here. All right, what else? Revenue bonds. All right, and then this right here does come up a little bit on the exam. Build America bonds. So make sure you refresh on that part. But they're not really going to ask you too much thorough questions. You know what it is, which is this right here. Bondholders pay tax on interest received from BAVs, but tax credits are provided in lieu of a tax exempt status, usually afforded the interest on municipal securities. And on the exam, it might ask you about Section 529 plans. This is pretty much for like saving money for college for your kid. That's all it is. Just know what it is. You have to know all the details behind it. I would say just make sure that you know this. Contributions, which are considered gifts under federal law, tax law, are made with after-tax dollars and earnings accumulate on a tax-deferred basis. Withdrawals are tax-free at the federal level if they are used for qualified education expenses. Okay, what else? And if beneficiary does not need funds for school, there are tax consequences. Okay. That's pretty much everything you gotta know for that. And make sure you know what this right here is too. Local government investment pools. And it's designed to be a short-term investment vehicle to invest funds. And these do not have to be registered with the SEC and are not subject to the SEC's regulatory requirements. And anytime when they do offer these, you do not need a prospectus to offer this. And a prospectus is something you were learning probably in like units 4, 5, or 6, somewhere around there. And then just know what this right here is: achieving a better life experience, ABLE. So it's for individuals with disabilities and their families. Just know what that is, and the age restriction, which is age 26. Okay, talks a little about money market instruments. Just know what this right here, the definition, which is money market provides very short-term funds to corporations, banks, broker-dealers, government, municipalities, and the U.S. federal government. It has fixed income debt securities and short-term maturities, typically like 1 year or less. Just make sure you know that little part of it. And certificate deposit is what the banks issue. So when a bank says, all right, you can, if you deposit me $1,000, I'm gonna give you a 1% rate return for a year. So that they can give that 1% rate return, and the bank's always gonna offer that, saying it's gonna be guaranteed. That's more what the banks offer, okay? Okay. And this does come up on the exam as well. Just make sure you know the definition of it, which is a short-term time draft with a specified payment date drawn on a bank. Commercial paper does come up too on the exam, and then U.S. Treasury bills. Okay, what else? And this, I remember a little bit on the exam too, which is the repos. Which is just make sure you just know this definition right here. That's all you gotta know for this definition right here. Does anybody have any questions so far? I know I'm going pretty fast. Anybody have any questions? Anything at all? Okay, what else? So that's that pretty much. And this is the question to ask. Why would you place money, market securities in a client's portfolio? Because it's highly liquid, it's very safe, a good place to invest your money that will be needed soon. In doing so, the client will be inquiring the following risks. The rate of return is low, so it won't really keep up with inflation. Due to short-term maturities, principal is potentially being reinvested at a different rate each time the instrument matures. All right, so that's that. And then Unit 2 does talk a little bit about options. And for that section, for the options, there will be a little bit of math, which is going to be, if I can see it here, there's like a little chart. I'm trying to remember if I can find it here. Just know what a long call is, a short call, and what a buys are, bullish and bearish. Those are very, very important in definition whenever you're looking at the questions for options. And then there is some math here for like, there it is. This is the chart you need to know. This chart here. This chart here pretty much tells you, let's say they're asking a question about it's going to be a call and they're long the call, right? They want to write to buy bullish. So for bullish, they're expecting the price of, let's say, Microsoft to go up. So they're bullish. And if they're short the call, they're expecting it to go bearish, to go down. And if they're long put, they're expecting it to go bearish. And if they're short the put, then they're expecting it to go bullish. Just make sure that you know this chart right here. It's very, very important. And these right here are the questions they're going to ask you too. This is where the math of the exam comes into play. This is pretty much the only math that I saw in the exam. It's going to ask you if it's selling at this price right here, is it going to be at the money, in the money? Those type of questions what they're going to ask you. So make sure you just know how to get the numbers for calls and for the puts. The math is a little bit different, but overall the concept is the same. Is everybody okay on this? No? So Let me see if I can find an example here. Give me 1 second. Let me just look for an example. All right, let me pull out the PDF here. Options. All right, let's skip to that chapter.
It's one example is in page 56.
6. Thank you. All right, once it stops loading, come on, stop. All right, 56. All right, so right here, okay, so right here, this is the type of question they're going to ask you. If ABC stock is at $62, ABC June 60 call trading at 2. So now with this ABC stock trading at 62, a $60 call has an intrinsic value of 2. So you take the stock price, which is $62, you subtract it by the strike price, because this right here is the price that you can actually pretty much react on the contract. So that gives you an intrinsic value of 2. And this is right here is when they're going to ask you, when you get the number 2, in here it's going to be known to be trading at parity, and parity, a call option is at a parity when the premium equals intrinsic value. So intrinsic value found it to be 2, and parity was 2. So they're going to ask you those type of questions. Does it make sense a little bit? And there's going to be more math here for options. I want to say maybe you might get like 5 questions on options. And the math itself is not really that hard. You just got to make sure you know the definitions. If it says calls, you got to make sure that you follow this exactly. So a call is in the money when the price of the stock exceeds the strike price. So in this case right here, in this example right here, the stock is at 62 and we have the right of calling it at 60. So it's above that value. So it's going to be in the money. Okay? Which is this right here, in the money. And at the money, it's pretty simple. If it was 60 and 60, then it will be at the money. The only thing that does change a little bit, if I remember correctly, is the intrinsic value. That's the one thing that does change for calls and puts. But overall, the math itself, it's a bit simple. It's nothing too complicated. Just make sure you know the definitions for calls and puts. Does it make sense a little bit?
Yes.
Yes? All right, so that's that. Like here, they show you a little example about parity for puts. So if remember for puts, we're expecting the price of it to go down, right? Majority of the time, right? So now with ABC stocks at 58, and we have the right to call the contract at 60, that puts trading at 2. Okay. Now ABC stock is trading at 58. $60 has an intrinsic value of 2. So we get the strike price, 60 minus 58. So that'll be 2. So the math itself for finding the intrinsic value, it's the same. You get the strike price, 60, minus the stock price, which will give you 2. Given this put contract is trading at a premium of 2, it is known to be trading at parity. So parity, it's going to be the same thing when the premium equals the intrinsic value. Same definition for calls and puts. And what else? And just keep in mind that calls and puts there are opposites. Like for this one right here in the money, it puts in the money when the price of the stock is lower than the strike price. So in this case right here, it's lower. So it's going to be this right here, 58 right here. The stock price currently right now it's 58, and it's lower than 60, which would be the strike price of the put. Does that make sense? Just keep in mind for the exam, like anytime when you see calls and puts, they're opposites. Are we okay on calls and puts so far, or you guys need a little more explanation on it? Good? All right. But you guys see how the math is not, it's not hard. You just gotta know the definitions behind it, okay? I think that's pretty much it for calls and options. All right, what else? And then you gotta make sure you know the trading dates, the settlement, expiration, exercise. You just gotta know the definitions, okay? So like the trading times is from 9:30 a.m. to 4 o'clock p.m. Eastern because that's the time in New York. And then settlement will be trade date plus 1. So let's say if you buy today an option, right? It's going to take you the trade date plus 1 day. Okay? And by business days, it does not look at Saturday and Sunday. It only looks at the weekdays, Monday to Friday, because the stock exchange is going to be closed on Saturday and Sunday. Okay. And there's no expiration date. And they can either exercise a contract or they can let it expire when the contract is over, okay? That's their options. And the main reason why they might want to let it expire is because they don't want to pay more money. whenever they have options, they pay X amount for that contract. If they don't exercise it, that's all they lose. If they were to exercise it, then they're going to lose more money in case it didn't work in their favor, if that makes sense a little bit. Okay. I don't remember too much questions about this, but for American European, it's a little bit different, but it's not going to show up on the exam. All right, what else? Let's see, index. That's not really that big of a deal there. And just make sure you know the option disclosure document. This might come up on the exam a little bit. Just know what it is. So it pretty much provides all the risk involved for options. It explains the strategies, the risk, rewards, and it is designed to provide full and fair disclosure to customers before they actually begin doing options trading, which are a bit risky compared if you were to buy stocks in the market for like long range, whatever it is, for long. And this right here, it's very, very important you know as well between the difference between covered and uncovered calls. If it's covered, contract is covered. The writer already owns the underlying security. And the main part of it is that it has to be covered because it has the writer the ability to actually perform the delivery of that security of how it's going to be performed. If the owner of the contract were to exercise it, and then uncovered is naked, this is a no-go. You never want to do this right here uncovered. Because this means here that the contract, the writer does not actually own that security. And if they if contract exercise, the writer will need to purchase the underlying security at the current market price to deliver it. Okay, what else? So that's that pretty much uncovered. And then there are hedging with options that can give you a little bit of protection. Okay, what else? And it's pretty much used to hedge to protect a long or short stock position. And why they use it? It's going to be used as an insurance policy in the event their core stock position moves in the wrong direction. For instance, if you have a put, right? You're expecting the price to go down, right? But if it goes up, this hedge will give you kind of like a cushion. Make sense a little bit? Okay, what else? Make sure you know what this right here is, protected puts. And then it's an investor who is long stock bullish could buy a put option as a hedge against a stock falling in value. So all this means here is that someone's going to be long the call and they're bullish, right? So to protect it from if it were to go down, he's going to buy a protected put as a hedge against stocks falling in value. So whenever you think about protective call, you want to imagine it's someone who has a long call and they're bullish and they don't want their stock to lower down in value. Now with protective calls, it's going to be the opposite. It's an investor who is short stock, bearish, and does not want the option technically to like rise up, right? So just keep in mind that's opposites. As long as you know what one of them is, you're good for the other one, okay? So just concentrate on knowing on one definition, and the other one is going to be opposite. And then I recommend you guys doing the quizzes. You don't have to be a boss at the end. These are actually quizzes I did a while back. If it's red, I got it wrong. So it's okay if you guys get it wrong. Just make sure you know why. And as far as the investment companies, the only thing that you do have to know, it's like a little chart. There it is. That's all you got to know. So he's got to know that the investment companies, it breaks down to three major classifications. There's base amount certificates, and then there's also managed investment company, and then unit investment trust. As far as FACs, these are less common. So they're not really going to talk about this too much, but just know that it breaks down to these three right here. Okay? And then managed investments, it breaks down to open and closed funds, okay? So open will be like a mutual fund that Primerica offers, right? And anytime when someone has an open fund, it's cashed out directly to that. It's cashed out directly and they don't have to go to the secondary market. If they were to have one from the close end, they would have to cash it out in the secondary market. So it's gonna be more work for that investor who bought a closed end fund. If that makes sense. Okay. And then just make sure you know the definitions. All right, what else? And then make sure you know this table right here. This table is very, very important. It just tells the difference between an open and a closed end, because this might actually come up on your exam a little bit. Does anybody have any questions on this table before I move on? No? All right, moving on. And then there are variable contracts, which are annuities. So annuity, all it is that it's going to provide income pretty much until that person dies. And the goal that person actually has an annuity is to actually surpass that contract, and then it's going to eat out of that insurance company. And then what else? What else over here? And this right here, make sure you know what it is. This is well here, morality guarantee, because they will come up on your exam. And as far as annuities, there's fixed annuities, there's variable annuities. And the way annuity pretty much works, it's very, very similar to like a mutual fund. It's very similar to like a mutual fund, pretty much, in a separate account. We just can't call it that, but it's like that. And the reason why someone might actually get a variable annuity is that it can actually protect them a little bit for inflation, because cost of living is going to be increasing every year, right? So the variable annuity, it might give them a potential more money each month. Okay. And then just make sure you know this here too. Fixed annuities differ from a variable annuity. Fixed annuity is essentially promises a stated rate of return. Therefore, insurance company has a risk to provide the rate of return as promised. So whenever it's fixed annuity, technically it's not really a risk, it's more of a guarantee for that specific customer. So it's not considered a security. Which is right here, look, with no investment risk for the investor to shoulder, the product is not considered to be a security. If it's fixed, it's not considered security. They might ask you that question on the exam. It's they go a little more depth here regarding mutual funds. Just make sure you know what it is. And they might ask you a little bit of questions on net asset value. Just know how to calculate it. All right. But all right, I know it's a lot of reading, and you don't have to memorize everything. Just know the basic concepts. And this right here, it's very, very important you actually know them too. You gotta know what no load funds are, Class A, which is what we offer at Primerica, and then Class B, and there is C as well. Does anybody have any questions on the different types of loads for shares? If not, so I can expand it a little bit more. Everybody good on this? Just know the definitions. All right. And this is the part I was mentioning earlier. How to actually calculate net asset value. All right, this is how you do it. You get the total assets minus total liabilities. It equals your total net asset value of the fund. And you get your net asset value of the fund and you divide it by the shares outstanding. So that would be equal to your net asset value per share. They might ask you questions like these, like this. And the net asset value of a fund share is the amount the investor receives upon redemption. So that's when he cashes out. Okay, what else? And then this is what actually can affect a change in net asset value. Make sure you know this table right here. Does anybody have any questions on this at all? Anything? Everybody good? All right.
When you tested, did you see a lot of the net asset values?
It was maybe like one question on it, but it's very minimal. Just know what it is. And then prospectus is going to be a big portion on the exam. That is something they're gonna ask you. Make sure you know what it is, the rules behind it or whatnot. But overall, prospectus, it's a full disclosure of an investment and the risk involved, and it provides you more information on that investment. Like it provides you it discloses the 1, 5, 10-year performance history of the life of the fund. This is the main part. And make sure you know it does it 1, 5, and 10 years. It does it pretty much every 5 years. And if it's shorter than, let's say, 10 years, then it's going to have listed every year. And then summary prospectus, this can actually be used for a sale of a mutual fund. Okay. And then statement of additional information. This is if your customer is going to request it. If they request it, then you have to deliver it within a certain amount of days. I think it was 2 days. Let me see. Mutual fund are required to have a SAI delivered within 3 business days of an investor request. So make sure you know this question right here, within 3 days. So if someone requests it, you have to give it to them by 3 days. Yeah, go ahead, Ashley. You're gonna say something? Okay. Okay. That's all you gotta know for the SAI. And this kind of breaks it down a little bit more for you of why it's very important of it and what kind of information actually it contains. So if you really want to condense your time studying, just refer to this for like the disclosure documents involved for mutual funds, and then you'll be solid. Okay. What else? And this right here, they might ask you on this financial reports. So like if you already have like an investment, you probably already seen like in December or January that the fund actually gave you a little book which shows you how the fund did in 2020, right? So this is what this is right here, the financial report. They have one audited and one not audited. So like right here it says one of these must be audited annual report. Okay. So they might ask you a question about this. Just know that you have to at least do the financial report at least semi-annually, which means twice per year, right? And this is the information that has to report must contain the balance sheet, a valuation of all securities in the investment company's portfolio, income statement, and it also has to have a little bit about the fund's costs and fees. All right, so that's that. And as you already know, some mutual funds actually have non-US market securities. So that'll be like a emergency account, which is tied to a mutual fund. And this right here, just know what it is. Just know that it's a unique form of business that raises money to invest in real estate, oil, and gas equipment, leasing, and other similar business ventures. Just know what it is, because it might come up on your exam. And this part too. Are not taxed directly as a corporation would be. Instead, the income or losses are passed directly through to the owners of the partnership. the investors. So whoever's investing in this right here, this DPP, is going to experience the income or the losses. And it's considered highly illiquid, which means that you can't cash out your money direct. You can't cash out your money fast. Okay. Just know that there's different types of programs. There's real estate programs. There's oil and gas programs. Make sure you knows right there the different types. Leasing programs. And right here is limited partnership. This one right here, you can expect at least one question on the exam on this. Okay. And this right here, it will come up on your exam too, general partners. There's something that will come up on your exam, and that's for investors and a LP, which is limited partnership. And this means here like GPs have unlimited liability, personal liability for business losses and debts. And their role is to pretty much manage all aspects of the partnership, and they have a fiduciary responsibility to use the invested capital in the best interest of the investors. And then when someone has a fiduciary responsibility, pretty much that means is that you have money that can affect people. You're managing that money. All right, what else? Limited partners, a little bit more expanded. All right, what else? So I know it's like a lot of information. And you gotta know this right here too. Real estate investment trust, REITs. A real estate investment trust REIT is a company that manages a portfolio of real estate mortgages or both to earn profits for shareholders. REITs pull capital in a manner similar to an investment company, but are not investment companies, neither open nor closed. So just know the definition of it, and you'll be solid. All right, what else? What did I write here? The following are 5 important points to remember about REITs. An owner REIT holds undivided interest in a pool. Okay, REITs may or may not be registered. So they could be either public or private. And then REITs may or may not be listed. REITs are not investment companies, and REITs offer dividends. So just know these 5 pointers here for REITs, and you'll be solid too. All right, any questions so far? And I will send you guys later on this Word document. All right, hedge funds. Hedge funds, just know what it is. You don't have to know too much about it. Just know that hedge fund is for like higher net worth investors. And it's the hedge funds pretty much is going to be like the closed-end investment. And just know the definition of this right here too, the exchange traded products, ETPs. Okay. And then ETFs, exchange traded funds. Does anybody have any questions on ETFs? Anything on this? Nothing? No? And you're gonna have to know that the pros and cons of actually owning ETFs. And ETFs are they're not actively managed. That means that they're gonna have lower operating expenses compared to mutual funds. That's the main difference between ETFs and a mutual fund. Mutual funds they're more managed, so they're gonna have more fees compared to ETFs. Okay, what else? And then what else? Exchange traded notes. And then ETN, I do remember on the exam a little bit, but once again, it's more of a definition. The exam is mostly definitions. The only math you're going to see it's on the options. All right, let's talk more about the investment risk involved. And they will ask you about this too, systematic risk and non-systematic risk. Which is right here, the risk that changes in the overall economy will have an adverse effect on individual securities regardless of the company's circumstances. It is generally caused by factors that affect all businesses such as war, global security, threats, and inflation. So this is going to affect the entire economy as a whole. And these are different types that they actually have here for systematic. They have market risk, they have interest rate risk, and then reinvestment risk. And then one thing here is that do not confuse reinvestment risk with inflation risk. They're a bit different. I know they look a little bit similar. And the only one that can actually be reduced through diversification would be a non-systematic risk. Because every industry reacts differently to different events in time, like coronavirus, right? All right. And then business risk pretty much means is that it could be a bankruptcy. And then financial risk relates primarily to those companies that use debt financing and ability to meet the interest and principal payments on those debt obligations could lead to bankruptcy and once again total loss for the stockholders. All right, what's the rest here? Let me see. That's pretty much the end of the part one already. You guys ready? Do you guys have any questions? Anything that you guys had on units 1 to 6? Any questions? No, nothing. You guys ready for some quizzes? All right, let's log in. Steps of licensing. All right. All right, let's do a quiz. Dashboard. Securities quiz. Let's do custom quiz. Part 1. All right, let's do 10 questions. And then show score as you go, and then show answer explanations. All right. All right. So now with this one right here, with these questions here, I want you guys to be like actively involved. And we're gonna read together. So the customer recently approved to trade options buys a put contract. So when you see the word put, you already can imagine he's expecting the price to go down, okay, for the account's initial transaction. If the customer fails to return the signed option agreement within 15 days of account approval, which of the following transactions is the customer permitted to make?
C.
See? How about everybody else? You're just guessing? So you sure it's closing sale? You sure?
I think so.
All right,
I'm about to go with D.
you got it right. See? So the customer fails to return the signed option agreement within 15 calendar days. With account approval, the customer is permitted to do closing transactions only. Because the customer opened a position by buying, the only transaction permitted would be a closing sale. So you got it. And then subordinate, what does it mean right here? What does it mean, subordinated? What does it mean? So when you think about it, like sub, right? Substitute, right? There's a teacher, then there is a substitute, right? So it's going to come second. So which one do you think it is? Agree to pay back last of all debt holders. And we have here, we paid back before all senior debtors. Agree to be paid back after all shareholders. We paid back specifically before all mortgage bondholders. So where do you guys think it is? Remember, second. And the
I
word
think
talks about debt.
the first one.
The first one?
I think so.
You're correct. Good. Does it make sense why it's A? Or I'm going to explain a little more why it is.
Yeah, explain a little bit more.
All right, so when it comes down to it, let me turn this thing on. So now when it comes down to it, let me get my little pen here. All right, cool. So there's two levels. There's sub, and there's one above it for like regular debt. Why am I there? For regular debt, okay? So no matter what, they're going to be paid first. Then they're going to get paid second here. Okay? And after that, it's going to be the stockholders and whatnot, right? They're going to be paid the last ones here. It's in that little chart, right? I'm not sure what part of the book it is, but it shows you who gets paid first in the event of a bankruptcy. It's a little table, so make sure you refer back to that table. It could be in section 2.f. So go back to that section right there, and there's a little table there. Just refer to that. Does that make sense a little bit or no? Does it make sense a little bit? All right, next question. And hedge funds. Hedge funds, this one right here, it really comes down to more of the definition, and you actually know what it is, right? So which one do you think it is for this one for hedge funds?
C.
What about C?
See?
Oh shit.
All right, so it's going to be D, are not regulated under the Investment Company Act and no SEC registration required. Remember, when you think about hedge funds, you want to look at this right here, look. Because they're sold under Regulation D, which is going to be more about private. When it's private, majority of the time, they are unregistered. And therefore, therefore accredit investors, which means they have a lot of money, right? So there's less information needed, like disclosure documents. That's all you gotta know. It's gonna be private, it's gonna be unregistered, and you have accredited investors. I think it was over like $100 million, whatever the number was. But that's another thing they're gonna ask you too. What is an accredited investor? They're gonna ask you that question too. Does it make sense a little bit?
Yes.
All right, next question. All right, this one, it really comes down to knowing the definition. Restricted securities may not be sold until they have been held fully paid for, what is it? One month, 2 years, 1 year, 6 months.
D.
Perfect, D. Regarding options, it should be recognized at the maximum movement. Let me see. Regarding options, it should be recognized that the maximum movement for any underlying stock price could be as low as 0 or as high at its break-even point. As low as 0 or as high as infinity. You're okay there, Javier? I just see you like zoning out a little bit, like.
Now I'm reading.
All right. Or as low as the break even, or as high as the maximum gain point. And then which one you think it makes more sense? Remember, the lowest price it can go to is at 0 for a stock price, right? And it can literally go to infinity, right? So I'm gonna go towards B, right? What do you guys think? B? B, yeah. Like I already told you, any stock price could move as low as 0 or as high as infinity. That movement towards either of these points and the market attitude of the option position. Okay. Each of the following is considered a controlled person under the Security and Exchange Commission Rule 144, except, remember, when you look at the word controlled person, you want to make sure we look at this, right? If they own 10% or more of voting stock, they're considered a controlled person, right? So now let's look at A. Another company that owns 10% or more of the company's equity securities, that might be it. Actually, this is considered a controlled person, right? So that would not be it. Because we're looking for this right here, the part of the question. Except, right? Those persons who own 5% or more of the total beneficial interest of a company's common stock. This one might be it. Those persons who own 10% or more of the total beneficiary interest of the company. It has 10 or more, right? And right here, we have corporate officers and directors. Now, by definition, these are considered controlled person / restricted, right? So I'm going to aim towards B. What do you guys think? B or D? What do you think it is? B? All right, let's see what it is. Ah. B, see? All right. And then priority dissolution for preferred shareholders means they are paid before our creditors. So preferred, this right here, they're gonna get paid before any other person that have debt for the company, okay? So before our creditors, this one for sure, right? Before our creditors, after all creditors, and before common shareholders. So which one you guys think it is so far? We know they get paid first, right? This is the order right here, right? So it's gonna be preferred. Let me draw. So we know this is pretty much all right here, right? We got preferred. Then from there we got sub, and then from there we got common stock, common, right? So overall, that's the order when we get paid in the event there's gonna be like a bankruptcy, okay? In this case right here, right? So in this case, they're gonna get paid before all creditors, right? Because they're in front of common stock, preferred stock, and those different people there, right? So now that means they're going to pay before common stock. So that means it should be C, right? They're not going to get paid after common stock shareholders. So that only it's going to rule out A and D, right? So by default, it will just put you like C and B, right? And it's very, very important that you guys do this on the exam too. You guys pretty much say, oh, I know for a fact it cannot be 4. So you see anything that has 4 and you cross it out. And if you see right here, after all creditors, you cross that one out because it's wrong. So by default, by order elimination, it should be 1 and 3. Ah. Let me get the mouse. Where's it at? 2 and 3. So it was after all creditors. All preferred shareholders will be paid until all creditors with debts have been satisfied. They are paid first of the equity securities, which means they are paid before common. So I guess I was wrong. All right, so it's going to be B. After all creditors, before common shareholders. So we got to look at that graph once again, and it's going to be here at section 1I. Just go back there, and we'll look at it right now. Actually, section L1. Where's that PDF? All right, so that's that. All right, the owner of a listed put equity option has the right to remember put equity. He wants the price to go down, right? Bearish. So he has the right to sell the stock at the strike price, buy another put at a discount, buy the stock at the strike price, and sell another put at a premium. So which one do you guys think it is? Which one do you think it is? Which one? So which one do you guys think it is? It's going to be either A, B, C, and D.
I think it's A.
You think it's A?
Yes, sir.
Yes, it's A. The owner of a put, he's long, purchased the right to sell the stock at the strike price to those who are short the option. The exercise of those put is an instruction to assign the writer to the put. So it's going to be A. Just make sure you know the definition. And the buyer of a put has the right to sell the stock, the obligation to buy the stock, the right to buy the stock. Which one do you guys think it is?
I want to say it's A again.
A? So it's going to
Either
be
A or
B,
B.
the right to sell the stock. So let's go back, right? So this right here talked about the owner of a listed put equity option has a right to sell the stock at the strike price. And this one has the right to sell the stock. Because remember, this right here is pretty much when you have the contract for that option. He has the right to sell the stock. He can either exercise it or he may not. All the following securities are backed by the full faith and credit of the U.S. government except Treasury bonds, Treasury notes, Treasury strips, and Treasury receipts. We know for a fact Treasury bonds are backed by the U.S. government, right? So is Treasury notes. So that leaves us with Treasury receipts and Treasury strips and receipts. So now we're 50-50, right? So now, which one do you guys think it is? Either C or D?
C.
C? It's D. Treasury receipts are issued by broker dealers and they are backed by the good faith and credit of those that issue them. Treasury strips are the U.S. Treasury Department version of these, and therefore they are backed in full by the U.S. government, Treasury bills and T-notes and bonds. So Treasury receipts are issued by broker dealers. Remember when you strip it apart, you have the principal and the principal plus the coupon rate separated. So this right here is going to be considered backed by the full faith of the U.S. government. The one separate is going to be the Treasury receipts. So make sure that you know it's not backed by the U.S. government. It's going to be backed by pretty much the banker, not the banker, the broker dealer who did it, because they're issued by broker dealers. That's the key part here. Overall, not bad. 60%. It's good. You guys want to do another quiz? We can do let's do more questions on equities and 4 and 6. Launch quiz. All right, this one's easy, right? What class of shares have a front end sales load? C, A, B, or no load? Which one do you guys think it is? If you had to guess, which one you think it would be? Right here, this one, right? Class A. And then which class of shares have a 12B1 fee as the primary sales charge?
Class.
Huh?
It's A.
A? All right, the risk that an investor might not be able to sell an investment quickly and have a fair market price known as, remember, the risk that an investor might not be able to sell an investment quickly, so that's about liquidity, and at a fair market price is known as not inflation, call or reinvestment risk. That might be it. But I'm going to lean towards C. What do you guys think?
I agree.
And then regarding investment products, which of the following is true? All right, what else? Derivative securities represent ownership in an issuing company. Equity security represents ownership in an issuing company. And what else? Both derivatives and debt represents ownership in an issuing company. Whenever you do buy debt, you don't have ownership rights in that company, right? So I know for a fact it cannot be C, right? And it cannot be D. Debt security represents ownership in an issuing company. So it looks like it might be B, right? And Rule 144 stipulates that after holding restricted stock fully paid for 6 months, an affiliate may begin selling shares. Remember, he's still an affiliate, right? So he still has restrictions, right? So we know for a fact it could be A, right? Because it has long restrictions. And we know for a fact it cannot be C, right? And this right here seems a little bit too far-fetched, right? At the discretion of the issuer's board of directors. So it looks like it could be either A or B. Which one do you guys think it is, A or B?
I say A.
All right, good. A customer investing in common equity securities could realize all the following except. All right, current income via dividend declarations, potential hedge against inflation, protection of principal investment, potential of capital appreciation. And then this one right here, which one do you guys think it is? Because they could receive dividends, right? And common stock, this question asks about common stock. It could be used as a hedge against inflation too. All right, and then protection of principal investment. Is that possible? Can you protect your principal investment? What do you guys think it is? You think it's C? Yeah? And the benefits of mutual funds are the following except. It is diversified, right? They are professionally managed. Reinvested dividends are not taxed until withdrawn. And remember, like right here, look, mutual fund reports distributions annually to investors. Now we learned earlier, this should be saying semi-annually, right? Twice a year. So it should be either D or C in this case right here, if we were to guess, right? So now you're 50-50. And then which type of securities are most susceptible to business risk? Let's see. And this one right here, if you don't know the question, just think about it for a second. It could be any of these right here, right? Treasury bonds, we know it's gonna be guaranteed by the US government, right? So this one might be it. Because remember, treasury bonds, they're tied with rates of returns, right? So it could be D. What do you guys think? What do you guys think it is? We'll put D.
Wait, so the question is which one's riskier?
Which one is susceptible to business risk?
Okay.
We'll just put D. And then during times when interest rates are rising, which of the following preferred are likely to pay a higher annual dividend? Callable, adjustable rate, participating, convertible. So now callable, this pretty much means that it's gonna have a benefit for the issuer. So they're probably gonna call it back and give them something lower, right? And there's adjustable rate. Adjustable rate could potentially do this right here because adjustable rate, it keeps up with with inflation, so it could give you more dividends. And then participating is something a little more different, right? All this means here is that when there's profit from the corporation, they're going to give them a little more, but that's not always going to be guaranteed, right? And then convertible, it's a bit different. All it is that we're pretty much going to convert our preferred stock to common stock. So I don't think it's gonna be D. I don't think it's gonna be D. It's gonna be a little bit lower because that's something that's gonna benefit the person that bought the preferred stock. So it should be lower. Participate, I don't think it's gonna be that. So it could be B or A. What do you guys think it is? B?
I think it's B. I agree with B.
The decision to pay a dividend rests with. This one's pretty straightforward. And you know for a fact it cannot be the shareholders. If it rests on the shareholders, there'll be dividends every year, which is not the case, right? So it's gonna be A, right? And then which of the following would be included in a mutual fund's list of expenses? And this one just really comes down to knowing the definition. So which one do you guys think it is? Just say wild guess. Just say something like B, C. What do you think it is? We'll put B for now, right? And then which type of shares allow the investor to buy and sell shares at net asset value and have a 12B1 fee of 0.25 or less? So if they have a 12B1 fee less than 0.25, they can advertise themselves usually as a no load fund. Okay? So it should be A. We'll see in a bit. Rules to protect the public during initial public offerings include all the following except and this one right here looks a little sketchy. Shares may be held to reward others who can direct business to the member. Members may not withhold shares for their own benefit. That's true right there. Shares must be offered to the public at the public offering price. Members cannot take advantage of their insider status to gain access to shares for their own benefit. So which one you guys think it is?
A.
Okay. All the following actions would cause the net asset value per share of the mutual fund to decrease except, remember that little table that I showed you guys earlier on the notes? So this right here, the fund distributes dividends. That should allow the net asset value to decrease. The fund distributes capital gains. So now we're taking money away from the fund, right? A large number of shareholders make withdrawals from the fund. So it looks like it might be either C or D. Which one do you think it is? What do you guys think it is? C or D? You guys think it is C? An investor relies heavily on fixed interest payments on long-term 25, 35-year bond. Should be most concerned with inflation, legislative risk, financial risk, reinvestment risk. You think it's A? A Japanese computer chip manufacturer wants to attract U.S. equities investors. Which of the following securities would help the issuer to accomplish his goal? And he might do B. Remember, he's a Japanese computer chip manufacturer, so he could be in Japan. So I'm gonna say with B, right? What do you guys think? B. And there's no such thing as foreign depository receipts. A non-affiliate owns 3% of issuer common stock. The person will be considered a controlled person if a spouse owns. Remember, 3% plus X. If it's greater than 10 or more, he's considered a controlled person. So I'll put it right here at 11, right? So I think it's going to be A, right? The growth potential and the price of the per share is generally considered to be. Okay, let me see. And remember, preferred stock, technically it doesn't grow as much compared to common stock. So based off that, so it should be less than that of the issuer's common shares.
I
It should
agree.
be, it should be that one. Which of the following securities is the underlying asset used to create an American depository receipt? Common shares, bonds, preferred shares, or warrants? Which one do you think it is? It could be either A or C, right? So what do you guys think it is? Just guess what it is. What is it?
A.
A? Of the following stocks, which would be denied as penny stocks? Now, remember, when it's a penny stock, it should be unlisted, right? So right here it says NASDAQ listed, stock trading at $4 per share. This might be denied because it's listed. This one right here is listed too, so it should probably be 1 and 3. So B, what do you guys think? B? Let's see what we got. 80%. So now let's go to the ones we got wrong. So those right here, when dividends or capital gains are reinvested, they are still taxed. All the other options are considered benefits of the mutual fund. So B, this one right here. Okay. Then A. So this one right here, it's going to be common stock. Treasury bonds are not all suitable to business risk. They are backed by the full faith of the U.S. government. 11. So 11 was A. So 1 and 2. Shareholder records and services and investment advisory fees. And honestly, if you guys get like really, really good on the quizzes, that's going to help you a lot for the exam. And 20 was 2 and 4. So it was opposite. Oh, I read it as denied. It was defined. So make sure you also, when you read the questions, don't misread it. I read it as denied. I didn't see the F. So that makes sense why it's gonna be the opposite now, 2 and 4, right? Overall, do you guys think this is very helpful? A little bit?
This was helpful.
Yeah.
All right, that's it. I'm gonna. Anybody have any questions? Anything on the readings? Nobody have any questions on the readings or anything?
Hey Oscar, I'm kind of confused on like T strips and well, basically like that section, like T strips and then the receipts and stuff like that. I don't really get the difference between them.
Good question. So T strips. Let me go back there right now. So T strips, it's when like a broker dealer buys it, right? And he's gonna separate the principal and the coupon, right? Let me take out my Word document. I had a lot more notes. Let me go there. Strip, right? Let me start sharing my screen once again. All right. So just keep in mind with Treasury. Where's it at? All right. So receipts are not backed by the full faith and credit of the U.S. government due to being from a brokerage firm. So receipts are done by a brokerage firm, and that's why they're not backed by the full faith and credit of the U.S. government. So like whenever the broker dealer gets something like this, they're going to separate two things. The receipt, it's never going to be backed by the full faith of the U.S. government. Just keep that in mind. What else? Separation of the coupon interest payment from the principal creates a new security and provides investors with several maturity to choose from. And then here is more regarding the strips. And then just keep this in mind. Look, Treasury strips. Treasury Department has its own version of receipts known as Treasury strips. So Treasury strips, they're going to be issued by the Treasury Department. Okay? So that means it's going to be backed by the full faith of the US government, right? Now, that's the main difference between Treasury strips and receipts. Treasury receipts are issued by broker dealers. Does that make sense a little bit, Javier? Is that where you're kind of confused on?
Yeah, thank you.
Anybody have any other questions? Anybody else? All right, well, I think that's it for today. And that was pretty much the end of Unit 1. I mean, Part 1, whatever it is, Units 1 and 6. And I'm going to show you guys this Word document I created a while back when I was studying for my SIE.
Thanks, bro.
No problem. All right, so that's that.